Hello everyone, welcome back to this week's Technical Insights. Global equity markets ended the first week of September deep in the red after weaker than expected US non-farm payroll numbers that pointed to a slowing economy. Fresh August jobs data on Friday added fuel to concerns of a slowing labor market after a series of weak data during the week has sparked worries about the health of the US economy, spooking the markets and denting risk appetite in the recent weeks. Non-farm payroll grew by just 142,000 versus a 161,000 expected by economists. However, the unemployment rate edged down from 4.3% to 4.2%, in line with expectations. After the jobs report, Fed Fund futures pricing increased the probability of a 25 basis point reduction in rates from around 50% to 70% for this month. The 30 stocks Dow Jones Index lost 410 points or 1.01% to close at 40,345 points. Broad Index S&P 500 fell 95 points or 1.73% to finish at 5,408 points. Tech-heavy Nasdaq Composite Index tumbled 436 points or 2.55% to end at 16,690 points, losing the 17,000 handle, and is now more than 10% off its record close on 11th of July at 18,671 points. With a shorter trading week due to last Monday US Labor Day holiday, the Dow declined 2.93% for the week for its first losing week in a month. Meanwhile, the S&P 500 slumped 4.25% for the period for its worst week since March 2023. The Nasdaq Composite Index shed 5.8% for the week and recorded the worst week since 2022 as investors dumped risk assets like mega tech stocks amid the worries about the health of the US economy. Mega tech stocks like Amazon slipped 3.7% and Alphabet slumped 4%. Facebook Meta platform lost more than 3% and Broadcom shed 10% on the lackluster current quarter guidance. Other semiconductor names fell in tandem, with Nvidia and AMD dropping about 4% each, and the VanEck Semiconductor ETF declined 4% and posted its worst week since March 2020. In Asia, Hong Kong markets did not trade on Friday because of a typhoon after the city-state issued its first number 8 storm warning this year. The Hangseng Index capped the shorter trading week with a 3.03% decline, triggered by worries about China's weak economic situation and a slew of disappointing earnings results. This heightened the risk of a more intense slowdown in China growth, and that would require more support from the monetary and fiscal policies. Investors will need to continue to remain cautious as the Chinese market is still in the progress of seeking the bottom. Hong Kong stock market slipped for 4 days in a row, the longest losing streak in a month. Oil producers were the primary drag on the market as fuel price hovered around their lowest level this year. China Petroleum and Chemical Corp, also known as Sinopec, tumbled 6.1% to Hong Kong dollars $4.65, while PetroChina declined 2.9% to Hong Kong dollars $6.32. The Hang Seng Tech Index finished the shortened trading week down 2.04%. Tencent rose 0.2% to Hong Kong dollars $373.40. Alibaba Group Holdings said that it started to solicit comments from merchants on accepting WeChat Pay as a digital payment service offered by Tencent on its e-commerce platform. Alibaba shares, meanwhile, dropped 0.4% to Hong Kong dollars $79.80. In Singapore, our STI index finished slightly lower on Friday, down about 4 points or 0.12% to finish at 3,454 points. We observed a bit of risk-off sentiment in the middle part of the week, where investor sentiment dropped in tandem with the decline in the US market, and market goes into a holding pattern towards the later part of the week while waiting for Friday evening non-farm payroll numbers. For the trading week, our index added about 11 points or 0.34%. This is the fourth consecutive winning week for our benchmark index, building on the 1.62% gain we saw last week. Given that the three major US indices lost about 1 to 3% for the week, I think the STI stayed pretty resilient due to the STI high dividend yield characteristics, and when there's high volatility in the other markets, the STI stocks are usually seen as a safe harbor until the storm passes. The biggest gainer on the STI index was Logistics Real Estate Investment Trust, Mapletree Logistics Trust. It climbed about 2.94% on Friday, or 4 cents to $1.40. The biggest decliner on our benchmark index was Yangzijiang Shipbuilding. The counter slipped about 3.4% or 9 cents to $2.52, as investors avoided high-risk trade and a possible slowdown in China. With the interest rate environment most likely coming down, property counters and REITs are most likely to be the biggest beneficiary and poised for a rebound. So for this week's technical analysis, let's look at the logistic REIT of Mapletree Logistics. Mapletree Logistics Trust, or MLT, is the first Asian-focused logistic real estate investment trust listed on the SGX. From an initial property portfolio of 15 properties in Singapore, MLT portfolio has now grown to over 140 properties located across the Asia-Pacific region, including Singapore, Hong Kong, Japan, China, Australia, South Korea, Malaysia, and Vietnam. Last Friday, Maple Logistics unit price rose 2.94% or 4 cents to $1.40, capping a winning week. This is also the fourth consecutive winning week that we have seen since the middle of August for Mapletree Logistics. Looking at the chart, we can see that Mapletree Logistics unit price has been on a primary downtrend in the first half of this year. The year-to-date high was seen on 2nd of January at $1.74, and the year-to-date low was seen on 9th of July at $1.24. After hitting the year-to-date low on 9th of July, Maple Logistics unit price rebounded to $1.38 on the 12th of July, but was kept below the $1.40 level. This is a level that Mapletree Logistics was unable to break through since the middle of July this year, until last Friday, where it hit a high of $1.43 before closing at $1.40. Looking at the candlestick pattern last Friday, the long wick at the top of the candle suggests that this may be a false breakout or a premature breakout. The MACD indicator does record an increase in uptrend momentum on Friday, but for much of last week, the momentum was seen decreasing. The RSI indicator also breached the 70-point overbought level last Friday to a high of 71 points, a level we have not seen for Mapletree Logistics this year, suggesting that MLT is technically overbought right now. The next resistance level for MLT will be the 200 days moving average, which is the red line that you see here, now standing at $1.45. A break above this level looks highly unlikely for now according to the candlestick formation, as well as the RSI hitting the overbought level. For key support levels, the double bottom formation in the middle of April here at $1.29 and the year-to-date low at $1.24 could provide a good entry zones for investors looking to accumulate into Mapletree Logistics. And that will bring us to the end of this week's updates. If you do find this information useful, do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insights.